commercial real estate is down 21.5% peak to trough. What does that mean? If you lever that piece of real estate at 70 or 80%, then almost all of your equity is worth nothing. If you bought something at the peak and you're currently at the trough. It's the same rate of decline that we saw in 2008 in commercial real estate prices. And so if you look at a chart, if this is, kind of the 2008 chart, then this is the chart peak to trough, just slightly higher in value from, 2021 till today. What does that mean? That means that you have a very strange dynamic in the market where anything that was bought in that era of peak pricing is distressed. It's causing major foreclosures. You see it in office every day. You're going to start seeing it in multifamily on a regular basis. You're going to start seeing it in other asset classes as well. Regional banks this time around own significantly more of this debt than the 2008 financial crisis. So in 2008, it was all in the bond markets. I think today it'll be a lot in regional banks. And what that creates is buying opportunities. So you can buy these existing assets at a deep discount to their replacement value. If you can buy them in distress, either directly from the bank or in bankruptcy or in any sort of foreclosure proceeding.
Hi, Adam Gower here, founder of GowerCrowd.com and host of the Real Estate Reality Show at youtube.com/GowerCrowd. Welcome to this week's episode of the Real Estate Reality Show. My guest today is CEO of the Caliber Companies, or Caliber. His name is Chris Loeffler, and I actually met Chris some years ago when I was teaching real estate investment and finance at Cal Poly San Luis Obispo. And he came in, I think as I recall, he's actually a graduate over there. I hope he is. If he's not, apologies for saying that. But he came in as a guest speaker. And I was teaching 3 classes, all the same course, but one after the other. There were so many people doing my course. And so Chris very kindly agreed to take one of my lectures one day. And he went through, I heard him giving his pitch, or not his pitch, giving his story 3 times that day. And what I can tell you is he had visionary insight into what was going to happen in commercial real estate with crowdfunding as a result of the Jobs Act. So you want to listen to what he has to say today, because he has some really interesting insights into what's going on. And if his last time around, when he was talking about crowdfunding as many years ago as it was, is anything to go by, he's probably right again. Now, one little point here. Chris is going to talk about what it is to be a publicly traded general partner, publicly traded private real estate company. That's a contradiction in terms. And I asked him about, so how does that, does that mean you have analysts that look at your stock, right? So in other words, you can buy shares in Caliber. And I'm not making any recommendations or anything, but I just checked the analyst. He's got one analyst. Who apparently is saying that he thinks that the shares in Caliber worth $4 a share and it's trading at 80 cents. Oh my goodness me. So see what you think of my guest today, Chris Loeffler, and then look up his company. See what you can find out from the analyst what he's having to say as well. Could be a really good day for you. Right. All right. That's it. I'm going to introduce you to Chris. If you want to know more about him, I've got to say this. I've got to have a call to action. Go to GowerCrowd.com. While you're there, subscribe to my newsletter if you've not already done so. And it comes out every Wednesday. It's really cool. You can always unsubscribe. And we are doing some super advanced stuff in the coming weeks and months. So definitely sign up for that. Enough from me. Chris Loeffler of Caliber is my guest today. Here he is. Chris, super good seeing you again. Thanks for joining me on the podcast. All right. So I rudely interrupted you while we were chatting because you wanted to connect some dots.
Yes.
Between this idea of a public GP. What is it? Okay, pick up where you started because I know where you're going. Can't wait to hear the rest. Start again.
So
Tell me your story. Yeah.
Before I even start with the public side, let me start with our industry. And so Caliber has been in this industry for 15 years, since late 2008. And as you know, you and I know, and I'm going to call you professor because I just can't.
Get extra credit for that.
Extra credit for the professor. We started in late 2008. In 2013, 5 years into our business history, the Jobs Act was passed, and for the first time in the history of America since the Great Depression, you could publicly solicit for a private real estate investment. Some people call that crowdfunding. I just call it public solicitation. And we were doing real estate funds. And so we became one of the first companies in the country to adopt a public solicitation, which meant that we put up a website. We taught investors about private real estate fund investing and doing syndications and doing these types of private equity real estate strategies. And to make a long story short, that first 5 years from 2013 to 2018 was like the proving ground for this industry, and we were the new guys on the block. We were doing things differently. We were raising a decent amount of capital and really building a business. And where we came to now in the last 5 years, from 2018 to now 2023, 2024, is we have the up and comers, the guys who sort of saw what we were doing and said, hey, we could do their syndication business, but we can do it 10 times better and raise more capital and go out there. And I think they're going to have some problems in this
I'm
market.
so interested that you say that. Yeah, it's
I'm very
fascinating.
excited to take you through those, but where I think the industry goes is it goes from nascent to evolved. And what Caliber has done is in the middle of last year, we took our operating business public. So for the first time, again, in probably the history of the country, you have an opportunity, or investors have an opportunity, to buy stock in the GP side of the business, the operating business that runs the private real estate funds. We're listed on the NASDAQ under the ticker symbol CWD. And I think that a public sponsor of private estate investments is the next evolution for our industry, because regulation is getting tighter. Investors are demanding more transparency. They're demanding a stronger GP. They don't want to see GPs that walk away from deals.
CGP.
Yeah, CGP.
What's a CGP?
Well, I'm just saying they don't want to see those general partners that kind of come in and out of the industry, and when a project goes wrong, there's no staying power. So they don't want to see that happen. And so that's what we're trying to solve for. And I think that the public sponsor of private real estate funds is going to become a category in and of itself.
Chris Loeffler, I want to tell you something. When you and I met, as you have kind of sideways alluded to, I was teaching a course at Cal Poly San Luis Obispo on most real estate investment and finance. You were a guest speaker, and I heard you talking 3 times to all 3 of my classes. It was visionary then. It was how many years ago? I can't even remember. It's a long time ago. Right? And you were talking about all this stuff. And now what you're saying, now I realize what you were talking about was like spot on. So let's drill down on this, because I think you're spot on again. Only this time I'm going to listen harder. Kidding. I'm totally kidding. So the idea, so here's something else that was talked about at that time, was the challenge of having these sponsors, these private equity shops or private sponsors, was that there was no transparency, very little transparency, virtually no disclosure, no oversight of any sort, and interestingly, no analyst coverage.
Right.
So is that something that, as a publicly held general partner, as you are, somebody that now you can buy stock, it's a trade stock in your company, are you covered by analysts? Is this something that you see developing and helping with your business? How would you think it's going to contribute to the industry?
Yeah, the industry started to evolve when Blackstone went public years ago. As the largest real estate and private asset manager in the country, they took their operating business public, and that's what they are. They're a public sponsor of private investments. And then you saw Apollo go public, you saw Ares go public, Bridge Investment Group go public, Carlyle Group, TPG, some of the biggest names in the industry. Those are all institutionally sized, institutional scale businesses that have essentially been through their giant growth path and certainly are continuing to grow, but are taken public at scale. Caliber offers a micro cap version of that. So a small public company in the early stages of its growth, hopefully, where you're getting that same kind of structure of that public sponsor of private real estate investments. So to answer your question directly, we're covered by one analyst. just like every other small public company, we have to fight and scratch to get additional coverage and get additional recognition in the market. But that analyst goes deep on the business. He looks at everything we're doing. He values, caliber, and we hope to continue to attract additional coverage. You also have an independent board. You have real governance. You have quarterly calls. You have to report what's going well and what's not going well in your business. And to the benefit of those LPs, as the sponsor gets stronger, every year, hopefully every quarter, Caliber becomes a stronger and stronger sponsor of these private investments. Guess who is the oftentimes guarantor of the debt for your real estate investment? It's often the sponsor. And so the stronger the sponsor, the better the debt, the cheaper the debt. Well, that gives you more profitability in your real estate investment. In addition to that, if something goes wrong with the real estate investment, instead of having their hand out to you as the GP to say, hey, LPs, go cough up more money, maybe the GP can step in and put some money in and fix the problem. Not all the time, but sometimes. And so having a public sponsor of a private real estate investment really does change the dynamic for you, either as a private investor, or if you're not accredited and you don't have a $5 million net worth or a $10 million net worth, and you're not ready to play on the LP side, you can buy stock in the company, which is rare.
All right. So let me ask you about that. So real estate is a long-term business, right? It's you can't buy and you don't fix and flip or do any kind of planning on a quarterly basis. So how does a company like Caliber deal with the challenges of having to report quarterly and being expected to perform on a quarterly basis? How do you deal with that when really, I'm presuming, well, that your view is at least more than a quarter at a time, and probably, especially in your development projects, years at a time?
I think you have to take a long-term view and stand behind that, and explain to shareholders again and again and again that that's how you will and plan to operate the business, and that quarter-to-quarter fluctuations are going to happen in this type of a business model. And what they should be looking at is how we're tracking to our long-term goals, which is exactly how we're trying to communicate with the market. Before we went public, I had the unique opportunity to talk to a lot of public company CEOs about how they handled that exact question. And most of them said, don't go public.
That's right.
But everybody, I think the ones that I saw that had the most success were just helping their investor base, their shareholder base, understand the type of business they were. So, hey, look, if you're a trader and you want to trade on a quarterly basis, there's no problem with that. But maybe we're not the right stock for you. Maybe the best stock for you is something that is going to have those quarterly fluctuations where you're going to hang your hat on every quarter. But for a company like ours, a lot of the value we create happens over years.
Absolutely fascinating. All right, so let's jump back to this idea before we dovetail into what's going on in the market at the moment. And this idea that we've seen it before, the cyclical story with distress, etc. So you mentioned in the last few years a lot of new entrants coming into the market, and as a professional seasoned shop like you are, what have been the primary challenges of seeing, I hate to use this term actually, it's used a lot, newbies, people that don't have experience in commercial real estate coming into the market, marketing extremely effectively, and creating a lot of noise? What has been the impact of that? I can tell from your facial expressions and the comments that you made, it's very frustrating, but can you drill down on what you're seeing and how that is affecting what's going on in the market today? As interest rates have gone up, there's a lot of distress materializing.
I see more downside than upside, and I'm a guy who's pretty optimistic, and so that's hard for me to say. But let me try to be as fair and even-handed as possible.
Diplomatic, yes.
So thing number one, I come from a place of I want our industry to grow, and I did everything I could, especially in the first 10 years of our business, to try to promote the industry and to help people even learn about what we do. We were very open, this is what we do, this is how it works, and oftentimes those people would become competitors, but I feel like if you have good, high quality, ethical people in the industry builds on itself. And the more that investors become aware of the fact that they can invest in these private real estate investments, the better for me. It's not about this guy taking my market share or vice versa.
Hmm.
Having said all that, that's all because we're in a nascent industry that was still being, there's out of the 13 plus million households in the United States that are accredited investors, there's probably still not very many that truly understand this style of investing.
Right.
So, having said all that, let's see, what did we experience? Number one, they came in order to attract capital, did the same, made a lot of the same mistakes we made, which was they were overly aggressive on their pro formas, but that then made it harder for us to attract capital because an investor would say, well, look at this
Right.
guy's returns and look at your returns, and I'm going to go with this guy.
Mm.
And to the investor's detriment, it's very hard to compare between one GP and another. There is no Moody's that's rating us at this point.
Right.
And then thing number two is, again, to attract capital, if you don't have much of a track record, giving immediate distributions was the ticket. And so about 5 years ago or so, we started to see our investors coming to us saying, hey, your guys' deal sucks. I invested a year ago. I haven't seen a single distribution. And I invested in this other guy's deal and I got a distribution the first month, pays like clockwork every time. And you guys are clearly failing and they're clearly succeeding. And what we found was that the industry had started to evolve to include preferred reserve distribution reserves. So you basically giving the investor their money back.
Yeah, isn't that insane?
So,
I saw that. It was just like, how do you deals that didn't cash flow
yeah.
were paying current on preferred return? I said, how do you do that? I
And
said, it's easy. We just raise more money.
yeah, and we had to go along with it in some cases. In some of our deals, we said fine, and we just were very transparent. We said, look, if you want to invest in this class of shares, there's no distributions until year 3 because we're building a building. If you want to invest in this class of shares, you can have current distributions, but you're going to take a lower rate of return. And all I'm doing is giving you your money back. And surprisingly, at least half of the investors would prefer the steady distribution.
That's incredible. Yeah.
And so we evolved with that.
Are you primarily a ground up shop, Chris?
We move with the market. So right now, about a third of what I do is in income producing hotels. A third is in land development, and a third has been in multifamily primarily and some other commercial real estate, some specialty stuff. A lot of opportunity zone investing, and then going into the new market cycle that we're in. We've been 2020 to 2022, we were almost out of the market. We basically sold stuff. We were going to launch new funds in 2022. We stopped, and we didn't launch until late 2023. So we saw interest rates going up. We said, this is going to cause a turnover in the market. We need to reposition ourselves, and that's what we've been doing. Going forward, we think we're really well positioned to take advantage of the current market.
So describe the current market. Where are the opportunities? How are you going to find them?
Nationally, commercial real estate is down 21.5% peak to trough. What does that mean? If you lever that piece of real estate at 70 or 80%, then almost all of your equity is worth nothing. If you bought something at the peak and you're currently at the trough. It's the same rate of decline that we saw in 2008 in commercial real estate prices. And so if you look at a chart, if this is, kind of the 2008 chart, then this is the chart peak to trough, just slightly higher in value from, 2021 till today. What does that mean? That means that you have a very strange dynamic in the market where anything that was bought in that era of peak pricing is distressed. It's causing major foreclosures. You see it in office every day. You're going to start seeing it in multifamily on a regular basis. You're going to start seeing it in other asset classes as well. Regional banks this time around own significantly more of this debt than the 2008 financial crisis. So in 2008, it was all in the bond markets. I think today it'll be a lot in regional banks. And what that creates is buying opportunities. So you can buy these existing assets at a deep discount to their replacement value if you can buy them in distress, either directly from the bank or in bankruptcy or in any sort of foreclosure proceeding.
And are you seeing any traffic? No, traffic's the wrong word. Are you seeing any activity, stress activity? Most people are still waiting for the shoe to drop.
Yeah, I keep hearing that, and it's funny because 9 months ago, I was saying this is going to happen.
Right.
6 months ago, we started negotiating on deals. This month, we started putting deals in escrow. And so
Really?
everybody who's sitting around waiting is either not seeing what I'm seeing, or they're just seeing, maybe they just don't, they're not plugged in or whatever, but we're seeing real opportunities.
Oh, fantastic. So what can you give me some examples of the type of thing that you're seeing?
Yeah, so we put a deal in escrow, still unannounced, but I can give you kind of the broad strokes. It's a couple of office buildings, parking garages, excess land, et cetera. We would be buying it for one, somewhere between 1/10 and 1/7 of what it would cost to build, depending on how you calculate the cost.
Right.
And
Mm.
and then it's a conversion. We're going to convert to multifamily. So, that's a basis play. You buy at a deep discount and you convert. We're looking at several hotel deals
Right.
that are out of their cash reserves, and the PPP's gone. They can't refinance. They have to do their renovations, and there's great buying opportunities there too.
That's interesting. So when you and I met as however long, sometime after the global financial crisis ago,
Mhm.
uh, you weren't doing hotels. Well, tell me why you like hotels.
It's hard. We Caliber loves asset classes that are hard because
I see.
it keeps the
The riff-raff out.
I'm not gonna, that's your word. My word is it's a better moat. It's
It's a better what? So you say better.
a better moat against competition. So we like
Ah,
harder asset classes, harder strategies to
interesting.
execute,
Hmm.
complex tax strategies, things like that, where we can generate
Hmm.
a consistent and great rate of return in pretty much any market condition.
What about senior? Or, with this aging of America, it's kind of the, medical office or here's, I like to tell you, my
We're
students, when you and I met, I used to tell them that I'm an aging millennial. Didn't like to confess that I'm a baby boomer, but there's this huge
you're
weight. I mean,
you're young at heart, man. You're young at heart. We senior housing, student housing, storage, industrial,
mm,
they were the flavor of the month or the flavor of the year at one point in time.
mm,
So we hadn't gotten into any of that because at least in the markets we invest in, they were sort of overbuilt. We have gotten into behavioral health, which is sadly a fast growing and seemingly unstoppable category of healthcare services that are needed.
mm,
And there's just a massive lack of beds available in the country.
really.
But I think senior housing is going to pick back up again in the fact that we can now do projects at a better cost basis than we
And
could.
also medical office and anything really around this aging of America. Is that something that you're looking at as kind of an
Yeah,
opportunity long
even
term?
on the hotel side, we think there's an opportunity in wellness resorts because
Hmm.
as the boomers age and they start spending less money on cars and toys and might spend more money on time and wellness resorts and doing yoga retreats and that kind of
Oh,
stuff.
wow.
So we see an opportunity there too.
That's interesting. It's not the kind of wellness resort I would choose to go to, but my wife might. I'll go
Yeah.
somewhere.
You'll end up there. You'll be having a seance under the stars with a yogi.
I don't know. Distillery in Scotland's probably close to what I consider a wellness
That
resort.
sounds like a wellness resort to me too.
Totally different kind of thing. All right. So the last topic that we were going to cover is how is the real estate private equity model, in
Yeah.
your view, the business model, how's it evolving, right? What are you seeing the changes now as you look into your crystal ball? We kind of touched on a few things, competition,
Yeah.
AI, tech, regulations, etc. So,
Well, let me give our competition a compliment so I can get into that. The thing that they did that happened with these newer entrants, especially kind of the 2018 era forward, is they came into the industry when the technology tools had actually matured a bit and they started using them right away. And so, as compared to Caliber, who was used to still doing like written reports on PDFs and Excel-based stuff and that kind of stuff, they stepped right into these technology tools,
hmm,
built beautiful customer portals, created great communication and great reporting, and we've been doing the same thing, but we've just been coming from a different angle along the way. And so, I think that technology tools, especially some of the AI tools, will give an advantage to the incumbent and the relatively small company as compared to the relatively large company. We still see ourselves as a relatively small and nimble company. And so I think that it's a huge competitive advantage. I don't know how other than using these tools effectively, I would compete with some of the big boys. They are starting to do that, and we see that we can get a lot of leverage off of our smart, talented people by using these technology tools better. So I think the big evolution in our space is fees have moderated. What you can demand in a profit sharing interest, what you can charge in fees have all come down. And I think that's good for the industry, because I don't think that, people should be overcharging huge profit sharing interests on deals if they're not creating that much value. Two is you have a much more educated investor base, starting with individual investors. Now that's bleeding into their investment advisors. So the advisors in the last 5 years have really started to learn private real estate business, and Caliber has an entire in-house wholesaling apparatus to work with investment advisors across the country, so that they can teach them about these strategies. They can bring them onto their platform. Our investments show up on their customer statement. The reporting flows through like Fidelity, all the things that you would want to institutionalize investing in private real estate projects, that will all occur. And then the big one that I think everybody needs to pay attention to in our industry, if they're not already doing it, is the SEC recently put out some proposed language around some new rules around private funds. And what you can see them doing is you can see them continually tracking towards, gee, if you're going to go raise 100, 200, $300 million private fund, maybe that should be more like a public company. Maybe there should be public reporting from that.
Really?
So I think that, especially because I believe that some of the newer companies in our industry are going to really struggle in the next couple of years, and investors are going to lose money, and therefore people are going to complain. I think that there's going to be a demand from regulators, which inexorably goes in one direction, which is more and more regulation, to have more transparency and sort of like pseudo public company-esque reporting on these private real estate funds, which is why we took Caliber public, because we can operate our reporting infrastructure in a different way than most of our private competitors can. So what I think that's ultimately going to do is consolidate the industry. There's too many real estate developers and GPs and syndicators out there. There's too few investors. They can't all invest with everybody. And what investors really want is a best-in-class partner that they can invest with for years, decades, and generations. So I think the industry needs to consolidate a bit.
Chris Loeffler, CEO Caliber. You are that man. Thank you so much for joining me on the podcast today.
Just playing our role. Thank you, Professor Gower. Good to see you.
All right, that was Chris Loeffler of Caliber Companies. Chris, thanks so much for joining me today. What an interesting conversation. I am very grateful to you for taking time out. I know you're a busy fellow, and I really enjoyed hearing what you had to say about everything that you had to say about. I really do remember those 3 times that I heard you at Cal Poly, however many years ago, talking about how the Jobs Act was going to change commercial real estate investing, and it has all materialized. You were one of the only people really talking in these terms at that time. So thank you for joining me. And thank you, dear viewers, as well, for tuning in to listen to my guest today, to listen to the podcast. If you're not already subscribed to our newsletter, go to gowercrowd.com, subscribe there. It's totally free. It's really good, he said modestly, and you can always unsubscribe. All right, that's it. Thanks for joining me today. I'll see you next time. Until then, this is Adam Gower signing off.